What's up guys, let's go over breaker and mitigation blocks, abbreviated as BBs and MBs. So what is a breaker block? A bearish breaker would be the last down close candle in a most recent swing low. So this, in this example here, this last down close candle in this most recent swing low, prior to the most recent old high being violated. So this old high was violated here. So this is the swing low prior to this being violated. So the buyers that bought this swing low here and later see it violated will be looking to mitigate losses. So what does that mean? The buyers that bought at this swing low here, when price is going up, they're making profit, and then it hits this old high, this liquidity level, and then it goes down. They're under the impression that it's a breakout and that it's going to keep going up, but actually the liquidity was swept and we see displacement by institutions selling, going all the way down to here. So now the people who bought here are at a loss, and they're looking to mitigate their loss by selling their positions when price comes back up to here where they ordered. So when price returns to the swing low, their buy orders will be paired with your sell order, providing a potent entry point for a continuation downwards. And for a bullish breaker, obviously you just want to reverse this process. So for a mitigation block, it's pretty much the same. Here's an example. A bearish mitigation block involves the same process. Traders are looking to mitigate their losses after price trades down below the swing low they bought at. The only difference is no old high is violated, and mitigation blocks rank below breaker blocks in efficiency because of this, because the liquidity was not taken and injected into the market properly. But still, nonetheless, these positions are looking to get out of their orders. So how do you identify them? Essentially, I want you to remember this pattern with the line. So it goes up, swing low, it breaks that high, goes down past the swing low, and then comes back and continues down. A breaker block will take an old high, as we've explained, with its second price leg, so this price leg here, and a mitigation block will not do that. So as you can see, up, down, does not take it, down, up, continuation. So why are these important and how to trade them? Breaker and mitigation blocks provide entry points for smart money traders looking to capitalize off a change in market sentiment or a potential reversal. It is important to note that breaker blocks rank supreme in mitigation blocks according to ICT. So now that you guys have the gist of it, let's get into a few examples. So here's an example of a bullish breaker. As you can see, this low was created. Then we get a swing high. This low was broken. We trade past this swing high. We come back into it so that these positions who sold here can mitigate their losses, and then we shoot up. There's a little bearish breaker block example here. So we created a high. We swung down. This is the last down close candle in this swing. We come up. We break this high. Then we displace. We come back into it and we sell off. Here's another pretty good bearish example. We did trade a bit past it, but we still sold off pretty heavily. Here's another little example. So we created a high, created a swing low. That will mark our bearish breaker block. We came up, took this high. We went down, we came up for an entry, and then we continued down. Here's an example of a bullish mitigation block. Everything's the same except this low was not violated. So we created a low, created a swing high. We're going to mark this last up close candle. We came back down. We did not take this low. Then we went up and we traded into this. As you can see, the bodies of the candles rejected it. We did come back down into it, and then we went higher. Here's another bearish breaker block. So we created a high, came down, went up, swept that high, came down, went up, paired orders, and went down again. One thing I want to discuss is it's super great to see them real clear cut. You know, where the first swing, it's all up close candles, consecutive, then all consecutive down close candles, up close candles, and then a clear displacement down. This breaker did not work, by the way, guys. It didn't come back into it. Just want to let you know, I'm just using this example because of how the candles formed. But yeah, the candles aren't going to be as clear as this all the time. As long as you see it clearly going in the direction you want it to go, So a clear swing high, a clear swing low, a clear break of that high, and then you want to see displacement past this low. So you don't want to see any consolidation anywhere. You want it all to be clear. It doesn't have to be this fast and this consecutive with the buying and selling pressure, but you don't want it to consolidate. You don't want an iffy breaker block. So yeah, as long as you see this structure form clearly, and then you see displacement breaking the swing low or swing high that forms the breaker, then you're good to go.